Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories in corporate finance, and today we're diving into a report that is a bit like a slightly confusing cocktail of debt and interest rates. So, the Federal Home Loan Bank of Atlanta, or FHLB of Atlanta as it is known, dropped a Form 8K, and while it might sound dry, it actually tells us about how they're managing their money and where it is coming from. They get most of their cash by selling what they call consolidated obligations, which are basically just bonds and notes that they sell to investors. The interesting part is that these aren't just on the hook for the Atlanta Bank, but for all 11 federal home loan banks, meaning they're all kind of on the same boat financially. And get this, these are not backed by the US government, so it's all on the banks themselves. Let's jump straight to the numbers, because that is where things get real. This is where we see what they've committed to issuing. On the 24th of November 2025, they're issuing a bond with a CUSIP of 3,130 B8 QW5. This bond is set to mature on the 27th of March. 2026. The amount is a massive $1.5 billion. It is a variable rate, meaning the interest payments will change. And it is non-callable, so they can't just decide to pay it back early. Then, on the very same day, the 24th of November, another big one, CUSIP 3130 B8 QZ8, also maturing in March 2026, and this one is for $1 billion. Another variable rate, non-callable. They are really leaning into these variable rate instruments. Hold on. There is another one dated the 24th of November 2025, this time with CUSIP 3130 B8 R38. This one has a longer maturity date, the 15th of September 2026. Interestingly, this one is not non-callable. It has an optional principal redemption, meaning the bank can choose to pay it back early. And it is a Bermudan-style call, which means they can redeem it on specific dates after a certain point. The coupon on this one is fixed at 3.795%, and the par amount is $25 million. So, a smaller chunk, but with a bit more flexibility for the bank to manage. And just to show you the scale, another non-callable variable rate bond dated the 24th of November for $500 million maturing in March 2026. Then we see a couple more on the 25th of November, both for $500 million each, maturing in May and April of 2026 respectively. These are also variable rate and non-callable. That is easily over $4 billion in new debt being issued in just a couple of days. Now, what does variable single index floater mean? Essentially, it means the interest rate on these bonds will go up or down depending on what a specific financial index is doing. Think of it like a thermometer for interest rates. If the index goes up, your interest payment goes up, and if the index goes down, your interest payment goes down. This is how they manage their exposure to interest rate changes. On the other hand, fixed constant means the interest rate stays the same for the life of the bond, or at least for a set period if it is a stepped rate. That is the 3.795% bond we saw. It gives predictable costs for the bank. The optional principal redemption means the bank has the power to pay back the loan early. That is a significant flexibility for them. They can do this if interest rates fall, they can refinance at a lower rate. And who is signing off on this? Thomas J. Costello, as the MBS portfolio manager. This tells us who is overseeing these significant debt issuance decisions. So, what is the big picture here? The Federal Home Loan Bank of Atlanta is a major player in the debt markets. They are issuing billions in consolidated obligations, and these are essentially investments for the public, but they are not government guaranteed. They are using a mix of variable and fixed rate debt with a clear preference for variable rate instruments in this specific filing. This suggests they are either betting that interest rates will remain low or stable, or they have strategies in place to manage the risk if rates do spike. The optional redemption clauses on some of these bonds give them a tactical advantage in managing their funding costs. Looking at this report, the FHLB of Atlanta is showing a very active approach to managing its funding. They are constantly in the market issuing new debt. The sheer volume of these issuances, totaling several $1 billion in a short period, highlights their importance in the financial system. The fact that they are using variable rate instruments so heavily, especially for such large amounts, is a point to watch. If interest rates were to rise sharply, the cost of funding for these obligations could increase significantly, impacting their profitability and potentially their ability to lend. However, the optional redemption features give them some breathing room. In conclusion, the Federal Home Loan Bank of Atlanta is actively managing its debt portfolio, using a variety of tools to secure funding, while the issuance of billions in consolidated obligations is a sign of their robust operations. Investors should be aware that these are not government-backed, and the use of variable rate debt carries inherent interest rate risk. They appear to be strategically using call options to retain flexibility. Alright, that is our breakdown of this Federal Home Loan Bank of Atlanta filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.